Okay, so good morning, everybody. Welcome to our Dave's Top 10 Economic and Other Factors Realtors Should Know. We are pleased to have Dave Gerling with us. He's a local realtor, has been a realtor member with us since 2008. And he's a real estate economist, bringing over 30 years of financial service industry knowledge and expertise to his current role as realtor in the Newport Beach and the desert communities. Dave served the city of Newport Beach Harbor Commissioner as a harbor commissioner for 2 years. And he was also the Newport Beach Association of Realtors president in 2015. And he also holds an MBA from UCLA's Anderson Graduate School of Management and an undergraduate degree from USC. And I am pleased to present Dave Gerling.
Well, thank you, Kimberly. You know, I'm not one to correct, but I was so proud of the time I spent on the Harbor Commission. You said 2 years. I did 2 terms. I actually spent 8 years on the Harbor Commission and really enjoyed it. It was my way of giving back to the city. And I learned, as a result, I learned a lot about the city. So I just wanted to say that thank you to everyone out there that enabled me to do that. Kimberly, this is my first, so I want to make sure that everyone sees my presentation.
Yes, we see it.
Okay, great. So thank you everyone for attending and taking time out of your day. You know, I've been doing this Dave's Top 10 for a long time. And when I had the idea to do it, when I first got into the business, I realized that many realtors didn't know about certain economic factors. And I didn't see the realtors as at fault for that. I saw the real estate economists as being at fault for that because I don't think they do a very good job about putting some of these factors and topics into a context that we can use in our business. So I came up with this Dave's Top 10, and I determined what I think are the top 10 factors that we need to be following at a particular point in time. And I try to go through them in a way that will help us in our businesses. So now I'm going to attempt, there we go, I did it. So before I launch into the presentation, for those of you that are interested in getting a copy of the presentation, all you need to do is subscribe to my blog. I provided a code where you can register for free, and I'll leave this up for a moment. But just go to my website, go to the subscribe section. It takes you 30 seconds to fill it out, put in the code, and then you'll be able to access my presentation. And I'll have it up there within about an hour of completing the presentation. So I'll also have a screen at the end. I'm going to give it another 5 to 10 seconds for those that are writing it down, and then we will launch into the presentation. So here it is, Dave's Top 10. And I'm able to monitor questions. I'll refer back and forth. So if you have any questions throughout, I'll either save them to the end, or if it's germane to what I'm talking about, I'll try to address it then. But I would say that let's launch into a headline. This is Robert Shiller. I always like to start with the headline. This is Robert Shiller and talking about forecasts. Economists can actually accurately forecast macroeconomic changes a couple quarters into the future, but for the past half century, their one-year forecasts have been on the whole worthless. This is a Nobel Prize real estate economist sort of downplaying what economists do. And I think that we should take this to heart, that we need to understand that people are human. It's very difficult to read into the future. And so my message would be, take it with a grain of salt and live in the now. And let's look at some numbers. So here is number 10. We're going to talk about interest rates. And this is the interest rate forecast that 5 very stable groups, Freddie Mac, Fannie Mae, MBA, and the NAR, 4 of them rather, projected rates at the beginning of the year. And the one thing I find about economists is that they're all, you can see they're all within a couple tenths of a percent. They're not really taking any risk. It's kind of like a flock of some sort. But anyway, this is what they projected at the beginning of the year. And then here is what CAR projected. And I've got a few additional numbers. You can see in 2019, they were 3.9. They forecast 3.7 in 2020. It's going to come in at 3.2. And then in 2021, they're forecasting 3.1. And this is from 30-year fixed mortgage rates. Not much variability. I will say, though, that 2 years ago, when they projected, rates were in the mid to high fours, and they were projecting that rates would be higher. So as few as 2 years ago, getting back to the headline of Robert Shiller, they were projecting rates going from 4.5 higher. And in fact, 2 years later, we're in the high threes, and I'll show you in some later slides where we may get into the high twos consistently based on where rates are. So here's the 10-year Treasury, which is the benchmark for mortgage rates. You can see it's below 1. Just to give you a little context, before COVID, the 10-year was at 1 3/4. Just in March and April, when we entered the pandemic and the shutdown, it was less than 1%, and currently it's at 0.87. So you can see historical low rates makes for incredibly low mortgage rates, and that's what the 10-year looks like. So here's another slide to just show you, and I'm gonna, my first time to use the draw tool, I'm gonna draw around this little area here. This is the mortgage spread. So if you think about the spread to the 10-year, so if the 10-year is at 0.87 and the mortgage spread, and the spread represents what lenders need to compensate them for the risk that they perceive in the marketplace. And currently the spread is just under 2, you can see right here, but it got as high as 2 3/4. And that's, and the spike here is when we entered the pandemic. And so things were very uncertain. There was perception that there was a lot of risk. And so people asked the question, when rates came down like they did around the pandemic to under 1%, why didn't mortgage rates come down with them? Well, this is why, because the uncertainty created more of a risk premium or a spread that was necessary. And until that settled down, which it has done, rates didn't come down in sync with the regular treasuries. So sorry about that. It was a long-winded, sort of complicated explanation, but you'll see here with the next slide. Oops, it's not letting me go. Maybe I need to undo that. Let me see here. There we go. So this is what mortgage rates look like today. This is Freddie Mac coming out with their weekly survey. You can see the blue line, fixed rates are 2.84%. This is a survey that they do every week. And then of course the 5/1 ARM is 3.11 and the 15 years down at 2.34%. But what I always like to do is put it in numbers that we can use. So for a $500,000 loan, you can see here at the bottom, a 30-year fixed rate at 2.84 is going to be $2,060 a month, an incredibly low number. And then for $1.5 million loan, which is pretty common for us here in Newport Beach, $61.81 per month. So you can see rates are very, very low, and I would just encourage you to talk to your clients that are fence sitters and think that they can predict where rates are going. You never know where they're going to be in a year. And for those that want to take advantage of low rates, they should think about doing it. So number 9, interest rates is always the longest. So we'll get going. I'm going to try to get rid of this black or this green circle. Let's see. There's the eraser. There we go. So number 9, home buying trends. There's been a development as a result of what we've experienced in 2020, which is where buyers are looking for a safe haven away from some of the major metropolitan areas, and they're essentially buying a lifestyle. Causes are the pandemic challenges, disruptions, social unrest, and the realization that we can work from home. The results are that the markets for second home destinations have been on fire, and the beneficiaries are real estate markets that are more remote, affordable resort towns like Tahoe, Park City, the Coachella Valley, which includes Palm Springs, Ventura Mirage, and La Quinta. And the takeaway is expect this trend to continue. And let's look at some real life numbers. This is La Quinta. This is a snapshot. This is a CAR slide. The median price is up almost 44% in the last year. Home sales are up 95%, and active listings. We'll talk about inventory and sales because they're huge components of supply and demand, down 26%. Days on market 62, list to sales price almost 98%, and active listings that have reductions in price, only 19%. So the takeaway here is that this is very different for a market like La Quinta in the desert, where properties usually are on the market at least twice as long. There are more price reductions. There's more inventory this time of year. It's typically the time of year where people are putting their home on the market. So it's a very different market because of what we've experienced in 2020. Let's look at South Lake Tahoe. Similar numbers, the median price up 20%, home sales numbers up 126%, active listings down 66%, days on market 56, 100% of sales price to list price, and the number of listings that had a reduction in price only 15%. So these dynamics for these types of markets are very unique, and I expect that to continue. So I think we're going to see a lot of our clients looking to buy second homes. When I first got, number 8, when I first got into the business, I've always been a numbers person, and I'm very visual. And so this is the first index that I created. But what I try to do is see where prices have been, see where they are now, and see where they're going. And because I think seeing a visual, at least it gives you a level of comfortability to see where you're buying compared to where it's been, where it is today, and where you think the prices may be going. So this is the Balboa Island Price Index. And of course, my father and I have focused on doing business on Balboa Island. And the way that the benchmark on Balboa Island is what is lot value. And so 12 years ago, I created this index to look at what lot value is. And then of course, you can build on top of that to get values for homes that are on the island. But currently lot values of just under $1.9 million. And you can see what it's done since 2000. This red line represents a constant appreciation rate of, in this case, it's 4.75%. So if you bought a lot in 2000, it would have appreciated roughly 4.75% annually. But you can see this is 06, 07, where we had a little bit of a bust in the bubble. So this is the Balboa Island Price Index. Let's look at another one. This is one that I created for Villa, which is where I'm working. And this is Eastside Costa Mesa. And you can see this is the 06, 07 prices, and you can see where we are now, the constant appreciation rate of 7% in a very, very hot market. And again, I just think this kind of visual for realtors and for their clients gives them a lot of information very, very quickly. A couple more I wanted to show you. This is Newport Beach, looking at the 4 zip codes here. This graph represents the average of those 4 zip codes. This I always like to say it looks like an EKG. And the reason for that is it's not as smooth as the previous ones that I showed you, is because there's a lot of price variability. And there's sometimes low data sets. But it gives you a good sense of where prices are going. This is a 7.5%, this red line represents a 7.5% appreciation rate. And then the final slide I wanted to show you is going back to La Quinta. This is a sort of a micro view of a neighborhood in the desert. You can see since 2002 for single family and condos in this particular neighborhood where there are 1,000 homes. For the last 7 years, it's been very, very constant at 300. You can see right here, it's starting to spike a little bit. And I would expect that this line would go out here, given what we're seeing in the desert. Remember, there's a lag to reporting of data. But the reason this is flat is because unlike a place like Newport Beach, there's lots of land to build on. And so there's not a supply constraint like there might be in a place like Newport Beach. So those are indices. I think they're very helpful. I would encourage you to some degree, have a sense of where prices have been, where they are today, and then extrapolate where you think they might be going. I think your clients will appreciate that. Number 7, foreign investment. I follow this. I haven't done this in a while because it had trailed off. But the thing to be aware of is that foreign investors invested $74 billion in U.S. residential real estate, which is a 5% decrease from the previous period. But I'll point out that they invested $121 billion in the period from April 17 to March 18. So a huge drop in a 2-year period. The second point is that the number of existing home purchases by foreign buyers was 154,000. Again, it was down. And I'm going to go into the reasons why some of the foreign investments have been down. Median purchase price was 314 compared to 274 for all U.S. existing homes sold. So foreign investors are buying on average more expensive homes. Foreign buyers who paid all cash was 39% compared to 20% for all existing home buyers in the U.S. And then it's interesting that the top 5 foreign buyers are China at 15 billion, Canada, Mexico, India, and Colombia broke into the top 5, taking the place of the UK at 1.3 billion. I think a lot of that's going into Florida. China was at 30.4 billion in that period 2 years ago, and they're down to 15. The next slide will tell you why that is. And then the top 5 destinations are Florida, California, Texas, New York, and New Jersey. So let's look at some of the reasons for this decrease. Strong dollar. We've seen quite a bit of home price appreciation. People don't want to pay as much. There's U.S.-China trade tensions, the pandemic, restrictive immigration policies, travel restrictions, and restrictive investment policies specific to the EB-5 visas, which went up from, I think, 500,000 to 900,000 that you needed to invest. The takeaway is that despite this slowdown, foreign investors have continued to impact our market, and I think we can expect an increase in foreign investment activity, especially with the election of Joe Biden. I think wealthy foreigners who have been on the sidelines may be poised to start buying again. So I think, especially in Newport Beach, where foreign investment can impact our market, it's important to know what foreign investors are doing. So number 6, let's take a quick housing snapshot. This is a slide provided by NAR. Sales year over year up 21%. This is nationally. Median sales price is 311,800, which is up almost 15% year over year. And then inventory is at 2.7, and it was 4 months. And we'll talk about inventory here in a few slides. It was 4 months back in September of 19. So inventory, as we all know, is very, very low. So let's go into this is just another forecast by CAR, just to show that they think that sales are going to be up 3.3%. The median price will be up 4.4%. Housing affordability at 31%, which means only 31% can afford to buy a median price home. And then the 30-year fixed rate mortgage will be at 3.1%. So this is a kind of a snapshot of what CAR is looking for. Number 5, inventory. As realtors, we all know we suffer from not enough product. There's lots of demand, but there's just not enough product to sell. And that has continued to go down. You can see this trend has just been down sloping since 2009. And we're virtually the lowest level we've ever been at right here. In August of 2019, we were at 3.2 months inventory. And for those of you that aren't familiar with that, it's essentially how long it takes to sell the inventory that's on hand. And that was in August. And then currently we're at 2.1 months of inventory. And as a reminder, 6 months is considered normal, sort of equilibrium in the market. So we're well below, and essentially has created a seller's market here. One of the other indicators of inventory is active listings, and active listings have just plunged in the past few months. You can see they're down 50% as of the last reporting period. So another indicator that inventories are very, very low. Here's a snapshot of local. I did this calculation, and the calculation, for those of you who aren't aware, is you take active listings on a particular day, and then the 30 previous days sales, you divide those to get your month supply. So in Newport Beach, currently, month supply is 2.1, Irvine 1.7, and Costa Mesa 1.2. And these are the numbers. You've got active listings in Newport Beach of 259, Irvine of 541, and Costa Mesa of 107. And as a reminder, 2.1 months supply in California as of August 2020. Take a visual of this before I change the slide. Right here, look at these numbers, and I'm going to go to where it was a year ago. And look at this. It's almost down to half of what it was a year ago, 4.4, 4.1, and 2.8. So you can see we're down dramatically, and 3.2 here in California in August of 2019. So we're down dramatically and really suffering from very, very low supply in our marketplace. So why have inventories been so low? I keep a running list of numbers. I've highlighted number 7 and number 10, fear of not finding a replacement and just general uncertainty in the market. But there's so many other reasons that people decide not to sell, such as, grandfathered mortgage interest deduction, property taxes, capital gains that may be due, new construction's not keeping pace with demand, low mortgage rates. Some are reluctant to give up their low mortgage rates. So there are a lot of reasons to just stay in your home and not sell. Okay, number 5, home sales. Home sales in the US were up 20.9%, as we saw from this visual earlier. In California, up 5.2%, and in Orange County, up 4.9%. Remember, pending and existing home sales, as well as purchase mortgage applications, are very good measures of real estate market strength and demand for housing. So before I go any further, just know that supply and demand dictate where prices are going to go. And we have very, very low supply, very strong demand, as you witness here in the home sales. And that has led to prices increasing dramatically. And Lawrence Yun, the chief economist for NAR, just came out with a headline, which I'll share with you later, but he's calling it unsustainable. Demand is strong and supply is lower. So things to keep in mind. And here, let's look at what does it take to, let me just look at it here. Oh, these are sales in the period to date in 2020, and then for September of 2020, and just for the month in 2019 and 2020. You can see they're up tremendously, with the one sort of anomaly being Costa Mesa here in the period of last year. But otherwise, sales are just up tremendously, especially if you look at September year over year. We've got 44%, 57%, 38%, 23%, and 54% year over year for Newport Beach, Newport Coast, Corona del Mar, Costa Mesa, and Long Beach, the 5 cities that I looked at. So sales on a local micro level are just way, way up, which is creating a lot of demand for housing that we don't have to sell. Pending sales is sort of a precursor of where demand may be going. And because pending sales are slowing, you might come to the conclusion that demand may be slowing as well. So we'll want to watch that and see where that goes. Number 3, home sales. So the CoreLogic Case-Shiller Home Price Index, which comes out every month, which was released on October 27th, shows that prices are up modestly, I think, compared to what we've seen, but still at a very, very strong pace. 5.7 for the 9 US Census divisions, the 10 city composite at 4.7, and the 20 city composite at 5.2. And here's where they were for the previous month. So they're up, and they're very, very constant at 3 to 5%, it seems like, over the past few periods. Takeaway is that home values are going to continue to appreciate at unsustainable levels, being fueled by low interest rates and low inventory and strong demand, this whole supply and demand relationship. And I want to point out right here, if you can see this, in fact, I'll do my draw tool again. And if you can see this area, this is sort of the dip right there is the pandemic, but it was fairly modest. You'll see on the next slide that, I'm going to undo this. Yep. You'll see on the next slide that it wasn't for California, Orange County. You can see here, let me draw again. You can see right here, there was a lot of variability compared to that other chart. This is due to the pandemic. This dip here was due to the pandemic. We saw a lot of trail off in the real estate market, but then it's picked up. This is a perfect V almost. You've heard people talk about the V-shaped recovery. And I think that's what we experienced, and we've seen it borne out in the numbers. But what this chart represents is the year-over-year growth rate for California and Orange County median home prices. And it was fairly consistent, just like a lot of the other numbers, in a range of anywhere from 3 to 7%. And then it started to trail off, and then we hit the pandemic, and it just kind of got crazy. But we're up at very serious numbers here in the 10 to 20% range, more due to the recovering from prices being down low. And it'll be interesting to see what happens going forward here. Let me get rid of that. Yep. So this is a graph of California median home prices. And the things I like, much like the Balboa Island Price Index, it's very similar. This is a constant appreciation rate of 5%. It's compounded quarterly. And you can see where prices are. We're at 20% above the peak that we saw in '07. Here to here represents 20%. And the California median home price in September was 712,000, an all-time record, up 17.62% year over year. And then if you look at Orange County, the median home price is 915,000, not quite a record. We had a little trail off. And again, Orange County is a lot like Newport Beach, and there's a little bit more variability because of the range in prices. But we're still 18% above the peak. From here to here is 18%. And then LA, you can see down here this number. Let me draw again. I'll draw around LA. Is their median home price is 747,000, up 12%. So all sectors that we follow are up tremendously on a year-over-year basis. And it'll be interesting to see if that continues. And most people are calling this sort of appreciation very, very unsustainable. Here is the quote that just is hot off the press. I just saw it after I'd completed my presentation, so I made room for it. But this is Lawrence Yun, made room for it this morning. This is Lawrence Yun, the NAR chief economist. Favorable mortgage rates will continue to bring fresh buyers to the market. However, the affordability situation will not improve even with low interest rates because housing prices are increasing much too fast. And that's the operative word, is this much too fast. It's just unsustainable. And they've been unsustainable for quite some time. And you'll see in some of these subsequent slides what the affordability looks like. In Orange County, only 23% of the people living in Orange County can afford a median price home, and that's 28 in California. Very, very low as I've ever seen it. So the takeaway is prices are going to need to correct or incomes increase significantly for affordability to improve. And what does it look like as far as what you need to make to afford to buy a house, a median price home in either Orange County or some of the other areas? And you can see, I put 2012 as a reference, but in the third quarter 2020, you need $127,000. You need to make $127,000 to afford a California median price home. A condo in California, 94,000. Orange County, 167,000. In the Bay Area, 194,000. And in the Inland Empire, 80,000. Comparatively, in the US, you need just under 58,000. So much, much affordable. And you can see it in these numbers. The Housing Affordability Index, you can see what the percentage of people that can afford a median price home is. And of course, in the US, it's much, much higher. This is a Q2 2020 number. They didn't have the Q3 number. The reason I have this column here just as a comparison is because 2012 Q1 was where affordability was up above 50%. So you can see we've gone from 50% or more affordability in 2012 to very, very low numbers. And much of it's due to the appreciation in home prices. Anyway, I always have thought that's an interesting slide to look at. And here's what the affordability looks like. We're currently, in the red line in California, we're just under 30%. And here in the blue line in Orange County, we're just above 20%. And here's what I just alluded to, Q1 of 2012, the highest affordability we had. Prices were recovering from the bust of the real estate meltdown, and prices were very, very low. Okay, and here's what it looks like by county. It's always interesting to see how the various counties stack up, but you can see here in California at 33%. This is for 2020 Q2. That number is now 28%. This CAR didn't have an updated graph, but 33% for California in Q2. And here's Orange County, if I can find it right here. So there are only 6 counties to the right of us that are less affordable than Orange County. So we have an affordability crisis, I believe, in Orange County. Here, surprisingly, the home ownership rate has gone up despite some of the affordability challenges, but we've gone up from a low of 62. I'm going to use my draw tool again because I've gotten to kind of like using that tool. That's the low. It's 62.9%. And we peaked just under 68%, and it's currently at 67.4%. So 67.4% of households that are owner occupied can afford to buy a home. So that's a little promising news from the home ownership standpoint. And then Dave's top 10, number one, let's talk a little bit about the election, presidency, propositions, and power. I have to do this. Let me just do this. There we go. Get the waving flag going. Okay, get my patriotic hat on. Okay, so what does a Biden presidency mean for real estate? Well, it all depends on Georgia. If Georgia falls to the Democrats, they'll have control to, I think, push some of President-elect Biden's policies through. But either way, what we're going to see is an attempt to have greater regulation. Joe Biden has talked about a $15,000 tax credit for first-time homebuyers, caps on rent payments, investing $640 billion over the next 10 years to promote affordable housing. And I think the real interesting one is going to be Fannie and Freddie Mac. They've been in conservatorship since we had the meltdown. And I do believe they'll stay in conservatorship under a Biden administration, whereas the Trump administration was trying to get them out of conservatorship. Why is that? Because Freddie and Fannie can be used to promote some of the policies that President-elect Biden has. So that'll be very interesting to watch. And by the way, the Fannie and Freddie represent the largest lenders in the world. So there's some serious implications with regard to that. So the propositions that affected real estate, I'm sure all of you know, Prop 15, 19, and 21. 15 and 21 failed. Prop 19 did pass. It was very close. But for those of you that don't know, there's a very positive aspect to 19, which deals with the portability, where you can buy a home up to 3 times of greater value and transfer your tax basis. But the negative part of that, which a lot of people maybe didn't see or didn't fully understand, was that heirs are limited as to how, unless they move into the home and they are given a home when someone passes, the tax basis is not going to transfer like it does today. So that's a negative aspect of Prop 19. But in general, it should do it should have a positive effect on increasing inventory with regard to the portability and giving people a better opportunity to sell their home and downsize or move to another area. The other two, Prop 15 was the continued attempt to erode Prop 13. I think you're going to see more and more of that until they're successful. And I think Prop 21, rent control, given the margin at which it failed, shows that no one's interested in that at this point. And the only local race I want to talk about is I was very sad that Senator Morlock was not reelected. And it's not necessarily because I'm a Democrat or a Republican. It's because he was a good watchdog, a check and balance to what's going on. He's very intelligent. He understands the finances. And I'm just sad that there's no one in Sacramento with his intellect that's going to be able to understand the issues that we face, like unfunded pension liabilities and the such. So just something to point out, the gentleman who won, his last name is Min, is a professor. So he may bring a level of intelligence where and fill that void. But I had a lot of respect for Senator Morlock, and it was very sad that he lost his election. So let's look at, we're home stretch here. Let's look at the top 10 interest rates. It's deja vu all over again. We're still at historical lows. The relocation trends I mentioned, expect those to continue. People are buying a lifestyle. Neighborhood indices are very helpful in showing where the market has been, where it is now, and where it may be going. Foreign investment, you need to stay on top of that because there may be homes that you have listed or buyers that are foreigners that will come into our market and support it. The housing snapshot, basically the message there was we've got low supply, strong demand, which is going to lead to prices going up further and further. Inventory is still very low. Home sales demand is robust. Home values, prices are being pushed to new highs driven by low supply and strong demand. Affordability is still one of the biggest challenges faced by our housing market. And the election results, buckle up. There's a lot to go, a lot to see in the future. So that is Dave's top 10. as I promised, here's the link to subscribe and use the code, and I'll have it up within the hour. And with that, I'll take some questions. Hopefully I answered the question about the copy of the presentation. As I said, give me an hour to get it up there. Are there any other questions? Is everyone out there? Kimberly, am I seeing the questions?
There is one in the chat. Please discuss default foreclosure risk.
Default foreclosure risk. Is that just in general, or is there a specific, I'm not quite sure I understand that question, that there's risk built in to, if you're talking about interest rates and maybe the mortgage spread premium that I was alluding to. Is that, maybe whoever asked that question can send me an email offline and at dave@reig.com, and I can address that further. Okay, I see one. Do you see a lot of Newport evictions once lifted? Any data on backgrounds in our local market? Oh, once the forbearance. Okay, so I think, am I anticipating evictions once the forbearance clears? And I think that clears at the beginning of next year. That's hard to say because there's so many legal issues involved in that, and the way California protects tenants. I think landlords are going to be very careful to evict, but I think they need to be strong about starting to collect their rent, which they've gone without in many cases for the last 9 months. And I don't have any data on back rents due in our local market. It'd be interesting to know how many people have not been paying their rent given this forbearance issue. Sorry, I don't have more on that.
There's another question from Chase. Do you see more and more people buying second homes, or that trend stopping?
Oh, so that gets back to my slide. In fact, I'll go to it. I think that's a trend that we're going to see in place for a long time. And here's the slide I talked about. I spend a lot of time in the desert. I own in the desert, and I can't believe what we're seeing, especially over the summer. The summer, which was supposedly is one of the slowest times, and there's not many listings, was just really robust. And I don't see that changing. I see people having changed their buying utility to go out and look for safe havens, look for places they feel safe, look for places that they can have a lifestyle change from what they're dealing with. People are very distraught over what we've been through in 2020. And I just see this trend continuing for some time. And so I would encourage realtors to understand their clients, and maybe you can help them find a second home destination as well. I don't see any other questions. Kimberly, anything that I'm missing?
No, I don't see anything either.
Okay. Well, with that, thank you, everyone. I appreciate your time, taking time out of your day. And as I said, I promise to have this up within the hour. And I welcome you to go and register and access it. So, Kimberly, thank you for the opportunity, and I'll look forward to seeing you soon.
Thank you very much, Dave. We appreciate your time.
You got it. Talk to you soon.